Nimesh Chandan, Chief Investment Officer of Bajaj Finserv Asset Management, with us on the show. We're going to be talking about the markets, as also talking about a very interesting product that they are coming out with. Nimesh, great having you. Thanks for taking the time out.
My pleasure here, Nimesh.
What's your sense, Nimesh? I mean, we've kind of been sideways if you take a 3-month view into account. Maybe that was anticipated considering we are hitting a big event. But there is to my mind, there seemed to be a slightly big change that happened overnight in the US data. Is that conducive, or you would still want to wait and see a slew of other data points before you bake in tailwinds from the global macro?
Typically, when markets are pricing certain events to perfection, now I'm talking about the US situation right now, that about inflation, unemployment, interest rate cut data. When you are so precisely priced everything, a small basis point change here and there in forecast leads to a big move in the market, and that's why we are seeing this volatility come in the US market. So right now the data is showing that economy is seeing some kind of a slowdown. Some lead indicators within unemployment are also showing, like quit rates, for example, have gone down. Temporary jobs are higher compared to the permanent ones. So those are some indicators that there is some softening on the economy. That should be followed ideally by a softening in inflation, and that should give some elbow room to Fed to cut interest rates this year. For Indian markets, I think, well, a lot of people put reasons to why we are not doing so well in the last few days, or large caps are not doing so well for the last month. I think it's a mix of things. I don't think markets are worried too much about the elections or so. VIX going up is normal during these times just before the election. So people try to price in, like, their factor in their estimates into the price. But otherwise, I don't think there's much to worry. The longer term trends are intact. And I believe India is one of the best placed emerging markets and one of the most attractive markets to be in even today.
Okay. So if the longer term trends are placed, and you guys are coming out with a multi-asset NFO, if I'm not wrong, which would mean that it gives you the ability to invest across spheres. If the longer term trends are in place, would the larger overweights be on Indian equities?
Absolutely. So we are launching a multi-asset allocation fund. In fact, the NFO has just started. Here we are looking to put about 65 to 70% of the corpus in equity. So it will be equity taxation multi-asset fund, 20 to 25% in fixed income, and about 10 to 12% in gold. Now we see opportunities across these markets today. Let me first start with the obvious one. If the interest rates go down, fixed income markets become attractive, and we will see a good coupon rate plus good capital gains coming from here in the fixed income side. Gold, because of geopolitical issues, and typically when economies slow down and interest rates start moving down, gold does well. This time we also have an additional new buyer coming into the market, that is central banks. A lot of emerging market central banks are also buying gold. So we are seeing positive tailwinds in gold also. Within equities now, we wanted to pick up a portfolio for our investors where you see lower volatility, lower chance of a drawdown in case the market goes through a correction, and attractive valuations. Now, one strategy that answers all these questions is looking for companies which are growing profits and also paying out good dividends. So we call it the GDP, which is growth plus dividend payout kind of a strategy, where you have companies attractively placed in terms of cash flows, are paying out these dividends to shareholders, but they will also sustain and grow these dividends because the profit itself are growing. And historically, this kind of combination provides investors with low volatile returns and moves them steadily towards the financial goals.
Yeah, that's true. That's true. But this higher weightage in equities is music simply because there's so many question marks around valuations. You think earnings growth and the favorable India narrative as well would take care of the higher valuations?
So actually, if I split the market into large cap, mid cap, and small cap, on the large cap side, we are not seeing overvaluation.
Okay.
So as a category, we believe that large caps are trading slightly lower than their intrinsic value. And typically during bullish markets, large cap trade at much higher range than their fair value. So our fundamental indicators show that large caps are slightly cheaper than their intrinsic value. Behavioral indicators show that the market is still on bull market. So that means we will cross this intrinsic value and trade higher. In mid caps and small caps, unfortunately, they are already trading at 20-25% higher than their intrinsic value, what they should be. Now, that doesn't mean across the board all these are like expensive, but you have to be a little more careful when you're choosing in mid caps and small caps rather than in large caps. So, and this portfolio that we are going to create has predominantly large cap companies. So we've taken care of valuation there. Plus companies with good quality cash flows and dividends, which means they are trading slightly cheaper than the overall market also.
Okay.
So that makes it more attractive.
Why is this large cap underperformance? Is it not because of people being negative on large caps, but because people being overly constructive on mid caps and small caps?
I think a lot of money in the past 1 year has moved towards mid caps and small caps. Large caps also have this huge shareholding from foreign institutions, which have been kind of mixed flows over the year and recently been a little negative. It is possible that some of these new investors are waiting for elections to get over and then allocate money towards India or reallocate some of their other emerging market money into India. I'm quite positive that that will happen because in terms of economic situation, in terms of corporate balance sheets, in terms of banking growth, in terms of household leverage, in every parameter, India scores well over a longer term compared to other emerging markets.
Got it. Sure, there are some themes identified where you would believe that once the money comes in, you would allocate. What is it that is the first amongst equals? What do you like the most?
So Neeraj, we look at markets more or businesses more in terms of mega trends rather than just sectors.
Okay.
Mega trends are changes that are long-term changes which impact economies and businesses and companies. We want to identify companies which are on the right side of these changes. So their businesses have a strong tailwind to forecast their growth. Some of the big trends we see is one in the power sector, where we see every technology change that is happening, AIs, data centers, electric vehicles. These are all power intensive, and suddenly the world has realized that they are underinvested in power. On the other side, there is a push towards renewable energy to go away from coal and other fossil fuels. So that means we will see a strong investment in power generation as well as transmission, in renewables as well as high-end transmission cables and network. Now, we have picked up companies which benefit from these and the entire power ecosystem, even some of the power financiers we have taken into our portfolio. The second area we see a strong growth is the chemicals market in India. Chemicals and pharmaceuticals, India is as strong as it is in IT. Chemicals went through a short-term downturn in the last 2 years, and we believe now triggers are in place for an upturn from here. The next, within pharma, we like contract research and manufacturing services. Indian companies have gone through again a down cycle here and are on an uptick. In US and in many of the other countries, they have this China plus one kind of strategy where they are looking at the other players than China, and India falls right there in terms of value. Biosecure Act is a very interesting point that you raised. I think this will be a game changer for Indian contract research companies. Absolutely. So we believe the runway from here for these companies is huge. You can buy a diversified list of some of these companies and create a good portfolio. That's what we do to benefit from the structural trend that is there. And the other trends we like is premiumization in terms of consumer discretionary spending. You see luxury cars or SUVs in auto sector. Travel and tourism is another area where, like, as people incomes grow, people start spending more on that, and government is also doing its job in promoting these sectors. So upgrades in lifestyle, moving up to premium consumption. Real estate is another such area where you are seeing premiumizing and also consolidation.
So you look at developers or do you look at ancillaries?
So real estate benefits a lot of companies. First, you obviously look at developers because they start the chain. But if you see later on, as the developments take place, you will see demand for cement, steel, cables, tiles, consumer durables, faucets, sanitary ware. So the entire chain of building materials to like consumer goods, everything comes with real estate. And this is typically a 6 to 8 year cycle. We've just been like 2 years into it now. So it's a long way to go, and plus a lot of more participants will come into this area.
Okay, I have a follow-up on one of the themes that you mentioned, which is chemicals. Had a fabulous last decade, been in hibernation for the last maybe 2.5, maybe even 3 years. The commentary is good but mixed even now. So are you convinced of the upticks happening immediately, or could it be, maybe it's a game for the next 3-5 years as a mega trend, but maybe the upticks start coming in with a bit of a delay?
So the chemicals market is a large market.
Right.
In general, there is an uptick, or what we can call it as bottoming out. Now, the speed of the uptick in different parts of the market can be different. In different chemicals, it can be different.
Okay, where is it you are more starting?
Dyes and pigments is one area which has already started doing well. You would have heard one of the largest players in dye chemicals actually filed bankruptcy. And that has led to some of the Indian companies actually benefiting from the price, and I believe that they would also gain more market share. There are a lot of specialty chemicals also where you will see Indian companies who have already done capex for the past few years. And that capex is coming for fruition now, and they will start seeing better growth in terms of revenues and profits from there. There was also some issue of destocking that was happening in the last 2 years. Probably after China opened up completely after COVID, there was some excess supply in the market that came in. Inventories went up, prices came down. Most of the large players, MNC players in the world, who are large in chemicals, have been saying that we are at the fag end of this destocking, and the prices have started recovering. So I'll see some of these specialty chemicals also benefiting. The last segment possibly to benefit would be the agrochemical side, which is still going through some slowdown and may take a little more time to come back. But otherwise, if you choose your players right in this, there is a lot to gain in this.
Okay, just before we wrap up, what are the risks here, and therefore does a multi-asset framework negate some of those potential risks? We have about a minute and a half. Yes.
So in risk, I would put it slightly differently. I see the risks in the Indian markets are people are getting impatient and want quick money. So you like the India decade story, you like a company which has 5 years order book and growth there, let's buy May futures for that. I think that's what worries me. That too much F&O trading, too much trading in, say, small caps and SME companies. I think that's a bit of a worry in the market, because that increases volatility. Investors, if they remain patient rather than trading in and out of these long-term trend companies, I think they would benefit more rather than just possibly giving it back to the market, whatever little they earn.
Choose mutual funds to do that, maybe.
Absolutely.
Great. Okay, Nimesh, all the best with the NFO. Thank you so much for coming out here and sharing some of these insights.